So let's say you owe 500,000. Is that lender making you insure it for over $1 million since it's going to cost that to build it if it did burn down?
Correct, yeah. So before you settle or close on a property, the insurance certificate needs to be shared with the lender that they're satisfied with that you need to be well and clear, because the bank will also have what we call a priority amount. So even if the actual dollar value of the mortgage is $500,000, they'll obviously account for growth. So legally, they'll usually almost double that figure, and then that could get adjusted over time as well. So basically, they can claim more or own more than the loan if they need to cover costs and things like that.
Welcome to the Everyday Millionaire Show with Ryan Greenberg and Nick Kalfas. All right, guys, welcome back to another episode of the Everyday Millionaire Show. We are here with Ilse Wolfe from New Zealand, all the way across the world. How you doing, Ilse?
I'm great. Thank you so much. This is an awesome random opportunity I didn't expect by coming to the US. So thank you.
Hey, we met you at Starbucks today, and randomly you were from New Zealand and have heard of our show before, and then we were like, oh, let's have you on the show, and here we are.
Yeah.
So, great stuff. So can you give us a little elevator pitch on who is Ilse in the real estate community in New Zealand?
Sure. So I was born in sort of a regional area of the North Island, but basically my adult life, if in New Zealand, has been in Auckland, which is our largest city. I started part-time investing sort of by accident while I worked in one of the main retail banks. We only have 5 banks in New Zealand. So I started there at 22, and through that exposure, I had one of those light bulb moments where, basically an accounting client took me through this profit and loss and all the great benefits that I think you still get in the US as property benefits, depreciation, those sorts of things. We don't have any of that anymore, but basically he sold me on the idea that was my solution when I said, hey, look, I get a monthly paycheck, and that would basically last 3 weeks, and then I'd have that last week of the month going, I need more cash. So that was kind of my first light bulb moment. Then later on, I was working over in Luxembourg, and then I actually jumped into property full time because my mother unexpectedly passed away while I lived over there, and that was the massive turning point for me, where basically she got robbed of her retirement, and I decided then that I was never ever going to be in that position or let that be my circumstance. So from 2015 I've been a full-time investor, and as I learnt lots of mistakes, lots of different wins, moved from single family to multi-family, and now getting a bit more into boutique hotels. In the last 3 years, I've run a coaching business as well, based on the BRRRR strategy, but I have a trademark called cash flow hacking, and there are certain strategies that I implement sort of on top of that to supercharge the yield. So I guess because of that initial idea, thinking, hey, I'll focus on equity and capital growth, and then being short on servicing, I then got super obsessed with cash flow. So trying to pull those things together.
So you mentioned that you started out in single family and now you're transitioning into multifamily. Are you still holding on to the single families, or are you starting to sell those to invest more in multifamily?
Is this what you've done? Because that's a really wise question.
No, I'm all single family.
Oh, okay.
Yeah, just a very small multifamily.
Okay. Yeah, no, so where the New Zealand property market is right now, we've, tough interest rates, stagnation of values, but we had a change of government on Saturday, and the expectation is they're far more pro-property investment, real estate investment. So I think there'll be a ton of buyer activity, a ton of seller activity, and prices will start to grow. So I see this next stage as pretty much selling off a lot of my standalone single-family properties to move more into multifamilies and boutique hotels.
So when our rates went up in America, is that what triggered your rates to go up in New Zealand as well? Or is your rates, how were your rates when our rates were at 2%? Were you guys low like that too, or are you never that low?
I think we lag slightly behind, but a similar pattern. And our rates are generally, New Zealanders, or Kiwis as we call ourselves, we like short-term interest rates, and we're always trying to guess, what do you think is happening here? But our 1-year rate, fixed rate, came down as low as 1.99 at its lowest. But hovered around the 2 to 2.5% for a year or two, and then has rapidly escalated up to about 7.2.
Currently?
Currently.
You said the government just changed on Saturday?
Yeah,
How often does the government change there?
every 3 years. So have you heard of Jacinda Ardern? She became like globally famous through the pandemic because she basically locked our country down for 3 months.
Yeah, I did hear a lot of like negative flack about New Zealand and how they handled the pandemic. I definitely heard that.
So basically, she unraveled from that point. She was like the hero at the beginning because we all thought we were protected, but all that did was kick the can down the road for the actual impact,
Right.
and just a whole series of things. She put the brakes on property because she is far more sort of left wing, and hiked up deposit or down payment requirements from 20% up to 35, which is huge, a real handbrake, and then removed interest deductibility from the profit and loss for existing properties.
Wow. So you can't write off your interest.
You can't. And so
Wow.
in a country that when you buy a property, about 80 to 85% of that property value is in fact in the land.
I want to touch on that because you said that in Starbucks, and all of us have been like rummaging this in our head. Like I can't figure out how that makes sense. Like you made the example. I think you said like a $650,000 property, 600,000 would be the land. Do you guys get 2x4s for like 2 cents, or like how does that make sense? Like there has to be building materials, right?
Yeah.
Are you living in sheds?
That's okay. The housing, we are so in deficit of the number of houses we need. The government is trying to stimulate new builds, so construction. So the cost of the materials on a new build as of right now, that proportion of the property value would be far more heavily skewed towards the building, or what our valuations call the improvements, so the house and the structures and the sheds and things. However, with existing properties, which would still be, 97% of the stock, because of the way that they've categorized, new builds are basically literally what just turned up now. Those older properties are very much in the land, because as each city or town has extended, the new builds are more on the periphery. So all of the existing builds, a part of that original city's infrastructure, are in the prime location. So the land is worth a ton, and the houses, no matter how old they could be 100 years old, 50 years old. Like for example, my property is central Auckland, very central, like Ponsonby, which is like the place to be. It's about 2 million US, and the value of the house is 150,000 of that.
How does your insurance work? Because I'm thinking like, okay, what if the house burns down or something like that happens? Like, how does the insurance company pay for that rebuild when the price of the land is so skewed?
So yeah, that's a great question actually. So there are online calculators. Do you have those here, where you raise a quote for your insurance for the house, and we call it the sum insured. So if the house burnt down and we needed to like for like rebuild it, it's then obviously at new building prices. So that material cost then comes into play. So the cost to rebuild the house is probably 1 to 1.5 million at that point. And then that would completely change the valuation, because it's a new build at that point. That would be a much more
Okay.
high-tech, valuable house.
So you're saying if the house burnt down to rebuild it, it would cost over $1 million?
Easily. Yeah. And my house isn't that big. I'm a super nerd. I put everything into my investment property. So my house isn't fancy. It's you might need to convert this, but it's about a 120 square meter house. It's 3 bedroom, 1 bath. Like, it's quite simple. But it's the location that is worth so much. Yeah.
Wow. And so how many people are in New Zealand in general? Like
About 5.5 million.
oh wow.
Climbing up
Okay.
towards that. So tiny compared
very
to here.
small.
Very small.
Yeah.
I have a question in regards to the insurance and you're having a mortgage on the properties. So let's say you owe 500,000. Is that lender making you insure it for over $1 million, since it's going to cost that to build it if it did burn down?
Correct. Yeah. Yeah. So before you settle or close on a property, the insurance certificate needs to be shared with the lender that they're satisfied with that. That you need to be well and clear, because the bank will also have what we call a priority amount. So even if the actual dollar value of the mortgage is $500,000, they'll obviously account for growth. So legally, they'll usually almost double that figure, and then that could get adjusted over time as well. So basically, they can claim more or own more than the loan if they need to cover costs and things like that.
Yeah, so when I refinance properties in Maryland, the way they do it is I only have to insure it for the amount of the loan that they're going to give me.
Really?
Yeah.
Oh, wow. So ours is greedier.
Well, it
Yeah.
makes sense though, because like you said, if it burns down, then
Right.
they
It's a
have to
real
rebuild it, and they know what it's going to cost at that point. So
yeah,
it
and
makes
that's
sense why they do it that way.
yeah,
So,
yeah.
you're here in America at a conference that all the speakers are American speakers talking about American real estate. What are you taking away from this convention, being someone that invests in a completely different market with different rules,
Mm.
different metrics? What are you here for? What's your biggest takeaway?
Well, number one was to solo travel and put myself out there. So I'm a property investment coach myself, and number one was to make new connections. Like my philosophy is like you never know where any conversation may lead, which is why I sort of struck that up with you guys this morning, because you just never know, right? And then
Right.
I find out you have a system and structures and similar ways you could help me in the same way that I do in New Zealand for my clients. So, where could that lead to? Maybe I can invest in the US. So I love the idea of one conversation could lead to anything. So definitely the connections and networking, number one. And then number two, because of the size of the US market, one, I've listened to American podcasts for years, even when I was back DIY renovating like 2015. And because of the size of your market, you have so many niches. I think you call them niche. Yeah. Niches. So like short-term rentals, medium-term rentals, boutique hotels. MTR and STR are relatively new as a concept. In New Zealand, we have basically purely Airbnb. Like that's what we call it. That's literally synonymous. Boutique hotels I only thought about or heard about because of American podcasts. So my goal was to come here and absorb as many different strategies, get access to as much content and information, and then work out how to apply that. Guinea pig my own portfolio when I get home. Again, like liquidating some of those standalone properties, I can play around with, hey, well, take some of these ideas and apply them. So then in turn, I'm more valuable as a coach and can offer other services to my clients as well.
Can you break down the numbers very briefly on your first rental that you purchased, and as far
Yeah.
as what you bought it for, how much is it rented for,
Mm-hmm.
and is that short term, long term, and like your cash flow per month?
On my original purchase?
Yep.
Yeah. So the first property I bought was back when New Zealand banks were doing 100% lending. This is pre-global financial crisis, like 2007. And did you have that here too? Like
Yes.
full lending? Oh, of
Yeah.
course. Yeah, you did. So that purchase price in New Zealand dollars was 346,000. So that's probably 230,000. This is 2007. And we call these a home and income. So there is a main house or main dwelling, and it had a granny flat. Do you use that
We
phrase?
call it mother-in-law suite or ADU.
Oh, perfect. Okay, so it's very similar. It was also part of the original build. So technically at that time, it wasn't a legally separate dwelling. So I underwent that process to separate them and basically have two dwellings. That ancillary dwelling in its own right can be tenanted under our tenancy law to a separate tenant. Until they're separate legal dwellings, they must be one family unit. So that added a ton of value, but I definitely fumbled my way through. And to be honest, I was led heavily by my boyfriend at the time because he was like this ideas person and was really a driver there. But dabbled in some basic, painting and fixing up weatherboards and that sort of thing, and landscaping bits and pieces. And then by adding that as a whole separate second income, that almost doubled, also refreshing the original house as well, it almost doubled the cash flow return. So my strategy initially from that point became to buy home and income properties to supplement and split that cash flow risk, which did prove quite handy. But I did have a really expensive mistake before I did that though, which was I did tenant out that whole property to one extended family. And it's a really sort of strange thing. I don't know how, looking back, how I could have anticipated it, but the letterbox that came with the house when I bought it had a lock. And
Litter box like for a cat?
mailbox.
Oh, mailbox. Okay.
Yeah. It had a lock.
Yeah, sorry.
Oh,
The
sorry, my
accent,
accent, yeah.
I was like, who would lock up their cat's litter box? That doesn't make any sense.
Makes no sense. Yeah. It's the E, isn't it? I spell my name ILSE. You hear A.
Mailbox. We got it. Okay.
So so basically, in a really short version of the story, turned out that the father, so culturally, the father in this family was supposed to take care of all the finances. So he said, "Oh, I'll rent out this whole property. I'll put my 20-year-old daughter and her partner in the ancillary out the back." Again, because one related tenancy. And turned out that he was completely overstretched. But no one knew this. His wife didn't even know this. And he became like 2-3 months behind on rent. And for myself, as a new investor, 22-year-old, walk in there, blonde hair, like look real young or whatever, he absolutely just kept giving me all the answers and pushback when I would go and say, "Hey, look, you're a week behind, you're 3 weeks behind," kept fobbing me off. But no one knew of his financial issues because he'd locked the mailbox. And so even his wife didn't know that they were behind and had all these creditors. Turned out he'd been gambling and then just getting short-term loans, really expensive loans, to pay off the one that was shouting the loudest. So I think I ended up about 15,000 in rent arrears at its worst point. And then the way our tenancy law works is we have to attach an order to their pay after a really long process. So I got that back at $50 per week over years. So
Wow.
that really hurt when I was trying to start out.
Yeah.
What does it look like the eviction process, like through, is it easy? Is it, you said it's long, like what does it look like?
Yeah, it's very difficult. Again, with the Labor government, it was more and more leaning towards the tenant,
Mm,
which is great. Like, everyone should have their rights, and but it should be balanced. It's become
right.
very difficult to be an investor the last 6 years. But there's a whole process. So we have the tenancy tribunal. When a tenant starts a tenancy, they pay a bond, but we don't, as landlords, hold the bonds. It's usually 4 weeks of rent, goes to the government in basically a trust account, and then the tenancy tribunal is the ultimate rule and decision on any disputes. But the length of time, so say for example, a tenant is 1 week, a couple of days in arrears on rent, we can issue a 10-day notice for them to remedy. And then from that point, if they don't catch up, we can apply to tenancy tribunal. So that's actually with an adjudicator. They'll try mediation, but the delay to get in front of a mediator can be up to 2 months. Meanwhile, that's 2 months of risk while you're still trying to navigate the situation. And then from there, if the mediation isn't successful, then that leads into court, and that again can be a 1 to 2 month wait.
Wow. So you're like
So
4 or 5 months
could be, yeah.
minimum.
And even at that point, the first judgment, they will order, hey, whoever needs to pay who net. That's just a decision. But if that tenant, and I've seen this many times myself, if they don't pay, then you have to repeat the process to go back a second time. It's at the second judgment they put the attachment on their salary.
So
Wow.
do you guys collect rent weekly? I know you mentioned that.
Yeah,
Really?
weekly. Yes, yeah. And then our mortgages, we can choose to pay half monthly or monthly.
And the mortgages before, you mentioned about like I think you said a 1 year rate lock. Do
Yeah.
you not have like 30-year mortgages?
No, this is why it was really interesting to hear yesterday. The market here is sort of stagnant because homeowners won't sell, right? Because they're locked in on a 2-year interest rate. Like, I would love that. I would love that. No, we have a 30-year term for a home loan. So whether it's your own home or an investment property with a main bank, so top tier lender, that would be 30 years. And then our rates, we have a floating rate, which is basically you can move to another bank and refinance without penalty. That's our floating rate. It's usually about 1% over all the fixed rates for that freedom. So the rate lock or fixed rate starts at a minimum 6 months and then maximum 5 years. But
Wow.
Kiwis generally jump between the 1 and 2 year fixed rate mark, depending on what they guess is going to happen.
Wait, so it'll go adjustable after that?
So you have to refix every 1 to 2 years is the usual pattern, and we'll lean on our mortgage broker. What do you think is going to happen? I mean, everyone's ultimately crystal ball gazing, but it's sort of you lean on the financial advisor, and Kiwis just have this pattern, but we don't have an option for over 5 years.
That's crazy because here,
Yeah.
like especially with single family homes, like Nick's got a ton of single family homes that he could figure out his cash flow from now to 30 years from now, and the only metric that really changes is when his rent goes up, he makes more money. And same with any
Yeah.
single family homes. For you to be able to only see 5 years in the future, if you bought a house, like this is why I'm scared to get into big multifamilies here, because anything more than 5 units, you can only lock in for 5 years. Sometimes they have 10-year rates.
Really?
But single families, you could do 30-year rate locks. So even at a high interest rate environment, if I figure out that my cash flow is good, I know that for 30 years, it's not going to get dropped off. But had I bought
Wow.
houses, 4 or 5 years ago, and now the rate is coming up, and I bought them at 3% back then, and they went up to 8% now, I'd be losing my ass.
Right.
And that's why
Wow.
a lot of multifamily investors are losing because, well, shortly coming up because of the interest rates are going up higher. They have to refinance that 5-year note, and they're going to have to refinance to a higher rate, and it wasn't underwritten at that higher rate, so they're going to lose cash flow.
Oh, so it's the multifamily. I'm now. Thanks for explaining that. So I realize, though. So here, the multifamily investors are more at risk
Yeah.
than
So,
standalone house
but
investors.
this is the difference. So here, a single family house is valued on comps, right? So
Yes.
if that house across the street sold for 300, this one is going to be valued somewhere around 300. With multifamilies, anything more than 5 units, so anything 4 units and less is considered the same as single family. 5 units and more, they value it as a business.
Mm,
So they do it based on your rent and your NOI.
yeah.
So what's good about that is that in a 5-year term, if you put in a 5%, which is our max increase in rent in Maryland anyway, if you put a 5% increase every year on your rent, naturally the appraisal in 5 years is going to be a lot higher.
Mm-hmm.
So then you can refi and pull a bunch of money out. But that only really truly works when the rates either stay the same or go down a little bit. When they double, now they're either the bank's going to ask you for a big fat check at the refi table, or you got to sell it or liquidate it because the value is so much less. Like once those rates go up so high, the value comes
Yeah.
down
So the
real
cap rate
quick.
increases and the value drops.
Yeah.
Oh my goodness, that's incredible. I've never thought about that dynamic. And
Yeah.
in fact, the whole reason that I migrated into multifamily, I mean, we have the same interest rate structure. So whether it's standalone, so residential, own home, holiday home, investment properties, or commercial properties, so 5+, very much the same, but for residential purposes, that's all still clustered in the same framework of fixed rates, 6 months to 5 years, 30 year. Oh, sorry. Multifamilies may be a shorter term, like 20 or 25 years, and sometimes a portion of that will be principal and interest, depending on how leveraged the investor is. But the reason I go into multifamilies and now boutique hotels is because the cash flow is so much stronger. So, a typical gross yield, so annualized rent divided by the purchase price of a standalone house, is typically around 3 to 4.5% in New Zealand. I help my clients achieve 8% plus through my strategies, but on multifamily, I expect double-digit yields all day, every day. If I can't get that out of the deal for myself or a client, we don't go ahead because there's an easier, better deal down the road. But that in itself should be more robust to withstand interest rate changes, I would have thought. And also, if they're cash flowing that well here, which it sounds like if they're done well, they do, does you're cash flowing so much. So is it that investors are not banking up enough of that residual cash? It's all being spent or reinvested into other assets?
Yeah, I think I think that's definitely part of it, right? Like you got to have some sort of reserve. If you're buying those assets that in 5 years they could be doubling and you could be needing some money, then yeah, I think that's on
Mm,
that's on the investor to make
mm,
that right financial decision. But
mm,
um I also don't think that people here, especially new investors, thought that we were going to get to a point where it was 2%. Now it's 9%. Like we didn't
mm.
think we were going to, I don't think any of us thought we were going to
No.
get there. So, again, without a crystal ball or something, it's going to be really tough to kind of make
Yeah.
those business decisions. Cause at the same time, when you're buying at 2%, maybe they just wanted to buy more. Like at that point. So all that money is going back into
Yeah.
buying more. And with those big multis, they can ask you to stroke a giant check and
Wow.
it's or you're going to lose the asset.
So does that basically mean that you need to be able to add value quite rapidly, right? Can the bank
That's the whole
also?
point of multifamily is you got to be a value add and you got to raise the rent.
Yeah.
Every year or over that 5 years, you have to do the math to figure out, okay, how much do I have to raise the rent? So then at my next refi table, they're going to give me money and I don't have to give them money.
Can they lean on that future value? So can you provide a rent appraisal and say, hey, I'm going to add value. These are the post-renovation rents.
Yeah.
Extrapolate the
Yep.
cap rate and then lean on that future value to draw the cash down to renovate with?
So they do that. I just did a build for somebody that refinanced it based on the future rents. But again, the issue is they're only willing to go like so far out
Mm,
because it's again adjustable. It's going to be changing.
yeah.
So yeah, it's definitely it's interesting to. So that brings me to my next question: how many of you are there? Are there full-time real estate investors? Is that like a popular thing? Is that a popular business to be in with all these tough, regulations
Mm.
and rules?
It's very difficult to be a full-time investor because of the difficulty to scale a portfolio in the first place. So 75% of Kiwi investors have one property and then 85 in total. So only 10% more of the market gets to two. So if you have three rental properties, so three standalone single family properties, you're in the top 15% of investors. So it
Wow.
doesn't take long to get there because also we have this thing called tall poppy syndrome. Have you heard of that?
No.
No.
So it's about like when you start to have success, it doesn't sound great for Kiwis, but we have this really bad overall attitude that when someone gets successful, we celebrate them for a short period of time and then we kind of get sick of them and we start to pull them down. So it sounds terrible, but that's kind of how the view has been cast over property investors. It's not great. And the thing is we provide 85% of all the rental demand. So our government can only supply 15%. So it's really ironic and strange that they make it so difficult for Kiwis to provide homes, and the regulations on the quality of the rental property you provide is so high now that there's these places are nicer than my home. It's like we
Right.
provide we call them healthy homes. Like that's literally a formal standard. So heat pumps, extractor fans, bathroom, kitchen, any sense of draft coming through older windows, you have to close that up. Like there's a lot of cost and maintenance that won't necessarily equate to value add, but you have to pay for as a landlord.
So what are the rents on a property, $600,000 rental that someone
Mm.
purchases there?
So so this would be that kind of price would be like Hamilton, which is one of the largest three cities, and that's say an hour and a half drive from Auckland, which is almost a third of our population. Um, and that would be a standalone house, say 4 bedroom, 2 bath. Pre-renovation, probably $500 a week, but after renovation, maybe $670. So there are some good gains, but even then, like that yield is probably about 3.5%, 4%. And whereas if I work with an investor and they like the systems I offer, which sounds like they're similar with yours, is I help them remotely invest anywhere in New Zealand because I have the team so they can have true confidence in existing suppliers. I call them power teams. So I will take that same budget and challenge them and say, let's go to another regional centre where there's still great population growth, a variety of economy and employers, that sort of thing, all that good stuff. But with subdivisible, developable land, and create an 8% gross yield. So literally dollar for dollar, I can get more than 670 per week in a property, including a full renovation spend for less than 500,000. So immediately that's like doubling the yield.
I feel like here we yield more on single family houses than multifamily.
Really?
As
Yeah,
a cash
like
flow is typically a little bit higher per property, but
Oh,
there's
there's more than
different.
manage, like individual ones
Yeah. But
versus.
also multifamily has different benefits, I think, and it's mostly that raise the rent, pull the equity, refi and pull that money out. It's like
mm-hmm,
the unlimited banking, model kind of thing.
mm-hmm.
But single families for us definitely like per door will
Yeah.
cash flow probably double. I would
Really?
say like
Mhm.
per door if you actually break it down. Yeah.
So that incentive to get into multifamilies isn't really there for some reasons.
Yeah, it's everybody has their thing, and I think what you mentioned in the beginning of the show
Mm,
is great. Like, there's so many strategies here that some people only do multifamilies because they want to get that free tax-free check. Because that's the thing. Like
Oh, what's that?
when you refi and the value goes up, and same thing with single families too. If our values go up and we refi and we pull that money out, you don't pay taxes on that money. So that money's
Okay.
not taxed, right? So if like we bought a house for 100 and we put 50,000 into it to 150, and let's say it appraised at whatever it appraised at, and we could pull out $50,000 at the refi table. None of that money gets taxed because it's technically a loan. So
Yes.
those multifamily investors, that's what they live and die by, that refi. That's that big,
Ah.
like their cash flow is less, but that refi is what that's where they make their big money.
Oh, wow. So that's the same. Yeah, we wouldn't be taxed on that. But yeah, so basically those investors sound like they'll be higher leveraged
Yeah.
because of that strategy, right? To extract a lot of capital.
Well, if the rents are raised, then the leverage may stay the same depending on how fast they were able to increase the rents.
True.
I mean, obviously, if you have a vacant unit, you can increase the rent more than 5%, for example. But if it's the same tenant, where we're at, you can only increase it by 5% each year.
Yeah. So that's a cap, 5%.
If
An annual
if that
cap.
tenant's still
Wow.
in there, but if that tenant moves out, you can increase it however much you want.
Yeah, yeah. So that's a new contract, right? So we have annual rent increases across the country are generally about 5%, but that's not regulated. What is regulated is we can only increase the rent with that same tenant once every 12 months. It used to be every 6, and that's
Okay.
been changed. I think a lot of changes that I notice are reflective of some of these details. So the Kiwi regulators are probably looking over here and seeing how are they, pulling back some of that growth and similar tools, using similar tools.
So the people that you're coaching, how are you finding clients to coach in New Zealand when it's not a very popular niche or niche, however you
Yeah.
want to say it?
So it's more that because it can be so costly, right? So you're sinking a lot of cash into the land before you've even added value to the property. It's very difficult to get it right. So it can be very costly if you get it wrong. So coaching isn't, I notice over here there are coaches for everything, and it's probably about a mindset. So I cater to the similar people that we've had at conference, so the mindset is self-development. So it would probably be a very niche part. I wouldn't actually know the numbers specifically, but my direct competition, there are about 4 other brands, but even then, we all have slightly different systems or focal points on our strategies. So one is purely buying below market value to, make some instant equity there. That's a part of what I do. But I have this cash flow hacking, which is, I say, look, you work with me, we'll get you 8% gross yield all day, every day. If it's multi-income, it'll be 10%. So that's kind of what I hang my hat on, as well as if someone wants to really grow a portfolio, then they need to work with someone because of those other sort of hindrances I mentioned.
So that to me, when you're saying like 8% gross yield, that number to me is so hard to fathom because ours are like double or triple that. Because if you think about like for us right now with the high rates, our CD, I don't know if you guys have something similar. Like a CD is basically like a bank note that you go to the bank, you put this in a CD, and you have to lock it in for a certain amount of time. So 15 months or 24 months. Right now, like a 15-month, I just got one. It was 5.5% for 15 months. So I'm getting 5.5% guaranteed that they can't lose my money. Like the bank has that money, they can't lose it. So I'm making 5.5% with no risk, zero risk. And then you guys are buying a house, which is risk, and only getting an 8%
Well,
return.
for the house, three and a
Yeah.
half, right?
Yeah.
4%.
Yeah. So I think that when I hear lots of different case studies and examples for single family, that's like the bulk of where investors in New Zealand sit. So drawing that comparison and hearing how much investors here seem to cash flow, like net cash flow, it is astronomical. And I think it's a function of if you're buying houses for 150,000 and your rents are still, I think, 600 a week, 2,400 a month, like that immediately.
It's a little less than that.
All right.
Probably. Yeah, you're probably just under. We just closed a deal for an investor of mine. He bought it for 99. I charged him 65 for the construction. His appraisal came back at 240, and the rent's 2,000.
Okay.
And
Wow. But that's great, right? So if you even ignore exchange rates, just sort of saying 600 per week, that's just directly when you're buying a house for 150, 200,000, and we're buying houses, even if they're unrenovated, for 600, 650, 700 easily in our main cities. Proportionately, that's just so inferior. And so your debt is working much harder because you're focusing on the house and you have such a supply of land. So the other benefit with existing builds in New Zealand, despite all the ways that the government's made it tricky, is the development option. So the two things that my clients are taught to buy really well that I support them with is, number one, achieving that what we think is really high gross yield. And the second one is to factor in, we have the district plan. I don't know if you call that here, but basically the zoning rules for how intensive or how intensified that land can be. So ideally, one purchase, we'll have one house. Ideally, we can subdivide and end up with two lots. Then that's I call it a jigsaw puzzle. So you could sell that off, you could build on the back, double your return with that free land, or if you have to sell under duress or whatever, you can sell that back section without losing the original rental. So it's really favorable in that regard. By contrast, new build properties are generally terraced houses or apartments now. And so if you're a new build investor, you have no way to add value. Like, you have to wait 15, 20 years before your place gets run down enough to then differentiate it from its direct neighbors. And there's no land because the developer has milked everything for themselves. So if you sell that property, you've sold your rental. So I see that as a negative.
Yeah. I have one more question because I know we have to get you back to the hotel. You said 15% of all the houses in New Zealand are government owned. Is that like like our Section 8?
So of all, the rate of home ownership, about half the country, half of the adult population own their own home. Half, and it is increasing, about half or slightly more than half rent. So of all of the rental stock required, the government supplies about 15%. So that's, government supported tenants.
Do they so the reason I ask, because in America, we've had a transition away from government owned houses. So we have what they call a voucher program, or Section 8 voucher program. It's sort of synonymous, but we as private landlords can get money from the government to put people in our homes, but we have to manage them. So the tenant would get a voucher saying that they are eligible for 4 bedrooms. And then they would come to us and give us this voucher and say, I have a 4-bedroom voucher. Do you have a 4-bedroom house? But that our government just threw out. There was a book that I read, and basically our government just sucked at managing homes and managing houses. So they built all these big multifamilies in New York and had all this project housing, and it just turned into like a drug ring, and it was, not safe and whatever else. So our country got away from the government owning the stuff and pushed it into the private sector, and the government just pays the private sector to own and manage the real estate. So your government actually owns those houses and they manage those rentals as well?
So they own about 15% and they will manage, correct? Then there's an overlap. So one of the other benefits is if as an investor I choose to rent my property to we call them community housing providers, CHIPs for short, they are registered under the government and supplemented and supported financially by the government. So basically the government subsidizes these entities that look after different subsets of people in the community that need more help. So some of them might be like the Salvation Army. Do you have that here?
Yeah.
So the Salvation Army, then they're ones that look after, maybe they are medical health board referrals for mental health, like some subsets of people that need some assistance or cannot work sometimes. So if we, as private landlords, we are incentivized to rent to those people and those groups, and then we can claim the interest if we do that. So it really makes it like a proper business expense as interest. Some investors do it because they want to support those groups, which is great, and I think it's important to align your values with that type of group and choose the right one for you. But they do have different types of risks, right? So a mental health supported person is a different risk from, like, for example, another entity that literally rehabilitates people coming out of jail. That's a much higher risk, right? So
what about property management? Is that big over there, or pretty much the owners managing their own properties?
it's a really interesting one. I wanted to find out from both of you as well. So about 75% of Kiwis privately run their own rentals.
They only have one.
Yeah. So it's not arduous.
It's probably much easier than doing 90.
Yeah, that's right.
Yeah. However, if you're more of a, you have big goals, probably you are working with a coach, or you want to build a sizable portfolio and treat it as a business, there is a massive growth in having them professionally managed. So I always recommend that to my clients. The going rate is about 8% plus GST plus tax of the rent, and then some managers will include the quarterly inspection reports and cover maintenance at no margin. Others will charge you per inspection fee, charge you per maybe 10% on top of any maintenance that they organize for you.
Yeah, that's very similar to what we have here.
Is it?
We
Right.
charge 10% on maintenance.
Yeah. Okay.
But I have a flat fee structure, but most of mine are average for about like 6 or 7% of the gross rent is what I'm getting, and then a 10% margin on the construction or the maintenance, and then 1 month's rent for placing a tenant.
Oh, that's
So
very
so
similar.
I'll take the first month's rent, and I place a tenant, and they're 12 months or more.
Yeah. Who do you charge, the landlord that or the tenant that?
The landlord.
Yeah, so up until about 5 years ago, that fee was paid by the tenant, and then the government changed that, so now that's a landlord fee.
Wow.
I mean, I could try to charge the tenants that, but I don't,
Probably not going to get it.
yeah, you're not
No.
gonna get it.
Yeah.
Yeah.
Do you have a goal to start investing in the US?
I would love to. Yeah, I think the structure and the lending are the two things I need to get my head around, because of those yields and the cash flow, everything looks far more affordable. And that's the other key thing is the New Zealand household, which could be two adults. The income in New Zealand is lower compared to here. So in terms of one, being an investor looking to grow a portfolio, and then two, having really good caliber of tenants, I feel like that's a win-win, right?
So if they make less there, how do they afford the housing?
That's why most people get capped at one, because the servicing is so poor. So if I can focus my strategy on, hey, let's roughly double the natural rate of return you get, that will push you along further than if you take a house as you see it at its listing and take it as it is and get average rent. Then you've paid full market price for average rent. If you can buy a house that has 2 bedrooms with the right characteristics I'll teach you to look for, we turn that into a 4-bedroom rental, then you've distorted that return to a far better one. So that will support you for longer, meaning you can add value through their innovation and buy that next property sooner, or that will naturally come sooner as your salary catches up as well.
And do you need a rental license there?
To
own a rental property in Maryland, you need a rental license.
Well, not Maryland, it's county by county, but
Well, in Baltimore, where I am, mainly my portfolio, you need a rental license. So they have to do a rental inspection. There's an independent contract or independent inspector that can come out, inspect the property to make sure there's handrails, make sure everything is smoke detectors in case there's a fire, and also a lead test. That's big for any properties there that were built before 1978 to test for any type of lead.
Oh, wow. So a professional property manager that is in process of becoming regulated. It wasn't previously, but that's happening. And we have, third party sort of auditors for healthy homes and smoke alarms and things like that as well.
Awesome. So how can people find you? Online, on Instagram? Where are you at?
Yeah, great. So I have my business website, which is wolfproperty.co.nz, or Wolf Property Coaching on Instagram and Facebook.
Wolf Property Investing on Instagram. All right, guys. Until next time.